what I'm going to show you guys today is going to increase your win rate. It's going to avoid some silly losses that you might have been taking. But I want to show you guys the proof of the concept first. This is the concept that I've been using throughout the whole year, especially on my live account. And this is my live account performance from the start of the year until now, 10 green months in a row. And the thing is with this concept, it's very common, but I like to have my own twist to it, and it helps confirm my trades. It helps increase that win rate. It helps avoid those silly losses. So hopefully it will help you guys today. Now, what I'm about to show you guys can be completely avoidable, and it can also increase your win rate. But what a lot of us will do, we'll have a system that we have, whether it be playing off a sweep, whatever it may be, the strategy's there. But what happens is the entry model never confirms from the area that you're looking to trade from, and price just blasts against you and continues the other way, and you ultimately take a silly loss. Now you guys can see on the screen where we have this trade market here for shorts. People can look at this and be like, oh, it's swept the high, why can't I just look for shorts right here? Another thing to note is that this actually turned into a structure break as well. And what other traders would like to do here based off their system and strategy is they would like to mark up some other areas they can look for sells from. So they could mark up a high from over here. If it was potentially to be swept, you know, they could look for shorts off of there. They could see that high that previously came up higher as inducement. They could look for shorts from there, right? The only problem with this, and this is what I'm trying to teach you guys, is that it's not confirming. When we have a look at the external high at the very top here and price fails to take the high and then a rejection candle comes, that's the whole point, waiting for the rejection candle after the sweep, because that makes all the difference in the world, and it's going to filter out all of those silly losses that you're going to end up taking. If you had taken that second trade in the middle, there was still no rejection candle and you still would have gotten taken out of that trade. And some of you might be asking, isn't that a structure break at the top of those highs? Some people might consider that a structure break. For me, it is marginal. Whenever it's marginal, I like to have a look at the next time frame above. So this is on the 5-minute. I would like to go have a look at the 15-minute to confirm if this is actually a structure break. We know that there's lows here that have been taken previously. This is a confirmed structure break. There's no issue here, and we all know that this is a potential structure break over here. But to confirm it, we have a look at the 15-minute, and all of a sudden it doesn't look like a structure break anymore. It just looks like a plus S, which is my variation of a sweep for my continuation models and my no close models. So now we have the confirmation that, okay, price has not closed above at all on the MTF on that 15-minute, and as soon as that rejection candle formed after the plus S, it made for a good entry. So the whole point of this is to wait for your rejection candles no matter what system or strategy you trade. There's two more examples over here that I want to show you guys. Potential no close plus sweeps over here, so the plus S model. And the thing is with this, we can use this, you know, concept with any strategy or any system as long as we're waiting for the rejection candle. And it's better if we cycle our time frames as well and wait for example, on the lower time frame, we wait for the 5-minute, which is the highest lower time frame interval there is, 1 minute, 3 minute, and 5 minute. Always best to wait for that 5-minute rejection candle for the lower time frame setups. That's at least for me. Obviously collect data on your setups to see what works best for you in terms of the interval for the rejection candle. But you can see here price wicked below multiple times, but as soon as the bullish candle prints, that's when the entry presents itself for a potential long. And obviously there's going to be some form of weak high that comes along with that. That's exactly what I like to target. But this is the whole premise of it. You wait until there's confirmation, because if there's no bullish rejection candle forming in this bullish setup, in this long setup, then there's no point of taking the trade. And sometimes price delivery is going to deliver the candle a little bit differently. For example, in this second setup over here, the bullish candle is massive. This is an appropriate time for you to potentially look at the 3-minute when that rejection candle is filled with volume and it's clearly going to close bullish. That's when you can start looking at, you know, potential 3-minute rejection candle if you like. Obviously you'll have to test it. And then you have another plus S model over here, and it's going to look a little bit different. This one's giving us a 5 risk to reward. Why is it giving us a 5 risk to reward? Because of the price delivery. Price is delivering a bearish rejection candle, which is still valid in our system. It's just a little bit of a smaller candle, which allows for a smaller stop loss when we obviously target that weak structural low, which is giving us a bigger risk to reward in return. So what this concept will do, will filter out these silly losses that you've been taking, and keep in mind that a bullish rejection candle and a bearish rejection candle can be any form of bearish or bullish candle, as long as it's a bullish candle, as long as it's a bearish candle. Could be full of volume, could be a bullish hammer, could be anything like that. It doesn't matter which type of candle it is. The only thing that matters is obviously the price delivery and how the candle delivers itself, because that obviously determines the risk to reward. And sometimes maybe on a lower time frame setup, we might be getting creating a rejection candle on the 1 minute, but it doesn't form in the 5 minute, and all of a sudden your trade has gotten blasted and you still get taken out. That's a good example of how the lower time frame creates a lot of fake outs compared to the high time frames. For example, the 5 minute, which is the highest interval of the lower time frame, there's a lot less fake outs, but in return, trade frequency is lower. So this is the main premise of this concept I'm showing you guys. Obviously, there's a mistake that some people are making in terms of, determining a structure break that is a wrongful structure break, and also taking a setup that meets their system, but it just hasn't given that confirmation with that rejection candle, whether it be on the MTF, lower time frame, or higher time frame. Doesn't matter. You can use the rejection candle on any time frame you want. Just have to make sure that price actually confirms for your setup, because if it doesn't confirm, chances are it's going to most likely, continue to run the high or continue to run the low and take your stop loss in the process of that. So it's a very simple concept. I know a lot of people like to use seconds confirmation entry, and I was one of those people, but I feel like there's just too many fake outs, especially with the 1 minute rejection candle. There's too many fake outs. Yes, it prints it, but then it just continues going the other way. The higher the time frame is, the better the rejection candle is, and you have to figure out the balance between having a reliable rejection candle and having a rejection candle that doesn't leave you behind on the sidelines.